housing slowdown points to an economic downturn. This is a direct quote from the St. Louis Fed. Hello everybody, Randy Patrick here. Welcome to another Housing Bubble 2.0 News of the Week video. And as you know, another episode of As the Housing Market Turns. That's what I like to call this sometimes. As I say, every day something new is hitting the news wires. Things are moving forward in the housing market. It's confusion, it's contradiction. There's a lot of stuff going on. It's difficult to figure out what this mess really is, but we're going to try to delve through it today. We're going to talk about the Fed, what they had to say, some resale price depreciation, some IPO stuff, looking at AI, which is artificial intelligence in the real estate industry. So we're still going to continue on that theme. Talk a little bit about mortgage applications and some rental stuff. So that's kind of scoop now. So again, if you could do me a favor, if you're not already a subscriber, just click that little button down the bottom right corner, subscribe to my channel. It helps us grow. So I'd appreciate that very much. And again, I know a lot of you have reached out to me. I'm going back and forth with people. If I haven't gotten back to you or we haven't hooked up, I'm going to be around all weekend doing some work and doing more stuff I need to do for my programs and things. So I'm available to talk, and if you want to reach out, again, I'll be around all weekend. All right, so there you go. So number one news, I guess you could say, the past couple of days was basically the housing is providing another in a line of troubling signs pointing to an economic downturn. And really what it boils down to is that declining home sales are consistent with the possibility of a late 2019 or 2020 recession, as per the St. Louis Fed's economist William Emmons said in his report. So now we actually have the government going on record saying, hey, we see some slowdowns going here in the housing market, and it's one of a number of items that could be contributing to a recession. And going back to the recession discussions, we've had them before, and obviously you've seen different points of view in the news and different channels here on this medium. A lot of it dealt with the yield curve inversion and other issues that are going on that typically almost foreshadow or foretell when a recession is going to hit. If I go to the yield curve inversion, it was the average is roughly 312 days, and if you go back to when that sort of took place and look forward with the 312 days, and that's the analysis based on the fact that when the yield curve inverts, a recession is usually 312 days on average after that. So that puts us into February, March of 2020, which is kind of consistent with everyone saying now. They're saying early 2020, so just keep that in mind. They took a look at the overlays of the past 12 months to 36-month periods to look at trends and also reviewed them against the past three recessions. Now, his point, though, was that this this recession, if it hits, would be much less severe than during the Great Recession that exploded in 2008. Well, again, they're not going to say it's going to be any worse. So it's going to be a recession. It's going to have issues. How difficult it becomes and how deep it goes and what the value loss is, we don't know yet. I would expect, for me, plan for the worst. Be surprised and happy if it's not quite that bad. But from our perspective, let's hope that prices tank a lot more than they've been doing at this point in time. So just something to keep in mind there. And they basically said that the current housing backdrop is similar to recent economic slumps, consistent with the possibility of a late 2019 or 2020 recession. So there you go. Data on single-family home sales through May 2019 confirm that all housing markets in all regions of the country are weakening. There you go. So that's what's going on here. Again, this is real numbers. So we've talked about indexes, we've talked about Case-Shiller, we've talked about a lot of things, but these guys are watching trends as well too, and they see it happening as well. So again, very, very interesting. Now, to put that into perspective, I have a chart here on the resale price deceleration that's a year-over-year calculation. And this was produced by a group called John Burns Consulting. They actually are a consulting group. They put out information on a bi-weekly, monthly basis. A lot of times they focus in on builders, new home buildings, their stock, what's going on, demographics, things like that. They're pretty good, quite interesting. They actually produced this earlier this week, and I guess you could say that this is the first real chart that shows resale price deceleration. So what it's doing is taking basically May 2018 prices to May 2019 prices, putting it in a chart for you. You can see it sliding down here. It's got about 30 major locations across the country, and if you take a look at this, it's sliding down everywhere from San Jose at the top to Raleigh-Durham at the bottom. San Jose is minus 26%, whereas Raleigh-Durham is minus 1%, and there's everything in between. You got the West Coast cities, you've got middle of the country, you got Florida, Dallas, Nashville, Salt Lake City, Boston, Atlanta. So you got a little bit of everything here. And what I've done, so hopefully this will work, because the first time I've done this, I've posted this image in the community section of my channel here. So I know that it's difficult to talk about an image and go like this so you can see it. You can't see what's on there. So what I've done is again, I'm learning this YouTube business. There's a lot that goes into YouTube. I just like cranking out the videos and talking, but there's a lot more to YouTube and managing your channel. So I've done a little on the community section or community tab. I've posted this, and you should be, as an image, you should be able to take a look at it. So, just refer to that anyway. But the point is, you see some pretty significant year-over-year price declines. Now, that's just the year-over-year on May 2019. That's not this. We're not talking about Case-Shiller type and values across the board, but we're seeing what was sold last year from a median price to what is sold this year. There certainly is some as I say, resale price deceleration. We're not saying appreciation, so we're saying deceleration right now. Again, to me, the number 1 and 2 and 3 is San Jose, San Fran, Seattle. Minus 26%, minus 15%, minus 13%. So that's really what we're looking at here, which is pretty significant. Now, excuse me, must be allergies and stuff getting me today. So what I found was also interesting is that there is an article out on Zero Hedge, and what it basically did was it took a look at recent IPO. So IPO stands for initial public offering for shares of companies. Typically, they're tech companies, and they actually sort of charted going, well, the areas where IPOs tend to originate are in where the tech space, which tends to be where in the West Coast, which tends to be where Silicon Valley, San Jose, San Francisco, West Coast, Portland, Seattle type of thing. So they just found it was an interesting correlation, or I guess not a correlation, a divergence, a curious divergence, that the top 3 slowdowns in the country as far as price deceleration happens to be the locations where we have the highest amount of tech going on and recent IPOs and or planned IPOs. So again, having Silicon Valley, San Jose losing 26%, San Fran 15%, and Seattle 13% respectively. It's interesting that here we have the tech epicenter, and what do we have when you have IPOs? You have instant millionaires, so people that were in on these companies early on that took stock options or bought stock when they were very, very cheap as employee incentives, will be able to cash out to a certain point of their stock, and therefore, as they say, we've just made a bunch of new millionaires, and those new millionaires are going to be hitting the market, and they're going to buy their properties. But it's funny enough that what's gone on recently, I guess, hasn't spurred a growth. That was the big fear, is that San Jose and San Fran would see upticks again because of that, because of these IPOs, and they've actually seen the difference. They've seen a reduction in year-over-year pricing, which I think is very interesting. So keep that in mind. Talking about AI, so the past couple of videos we talked about the iBuyers and how what they're doing and what we need to do to figure out how to work with them, against them. Again, I never really work against somebody. I look at it going, let's figure out what they're doing and how can we take advantage of what they're doing or plug into their system or find ways to monetize that. That's what I'm really talking about. And again, when I speak, sometimes I'm talking about my real estate investment perspective, where we can feed these guys properties. I know a lot of you out there are still looking for your primary residence or looking to buy at a cheaper price. That's different than obviously the investment side, but my point over the past couple of videos have been, we have to look at this as another sort of, I said, wrinkle in the fabric of real estate. It's not going anywhere. It's actually going to increase, and we need to figure out how to work within it, around it, to our advantage, as opposed to getting wiped off the face of the the earth. So interesting enough, there's an article that appeared the other day, and I'm reading it right now. So a Harris poll from April 2019 found that 72% of Americans believe that real estate commission of 6% is too high. Now, depending on where you live, 6% seems to be a customary accepted amount of commission. So typically when you list a property as the seller, you will allocate 6% for real estate commission that you're going to pay out of your gross sale price for the agents to list your property and to bring a buyer. Now, as a listing agent, the listing agent can bring the buyer and therefore grab the full 6%. But what normally happens is, based on the averages, is that there's a new buyer that's being brought to the table with called a cooperating real estate agent or broker. They're the buyer's agent, and you're splitting that 6%. So 3 going to the listing agent side, 3 being designated to the buyer agent side. That's typically where the 6% comes into. I know that there are some class action lawsuits now talking about that point, so we'll see where that goes. Also, 74% of Americans would like to have an alternative to traditional real estate agents. So, I guess what we can see is that people are just getting tired of what's going on here, and I guess people are getting tired of the 6% and what their agents do or don't do for them. And this again is based on technology, because a lot of people now, when you're looking for a home, what do? You don't call up your real estate agent friend and say, find me homes. You go on a third-party website. You go on Realtor.com. You go on Zillow. You go on other locations and look for homes in the desired area and your desired price point. So you're doing a lot of this, or I guess you could say, recon activity yourself. And then you're going to make those calls when you need to see property and things like that. So that's kind of where the market has gone to right now, and it's probably going to increase, where there'll be less and less use for real estate agents, which is understandable. So the question is, could artificial intelligence completely replace the traditional real estate agent, so just wipe them out completely? Well, the answer to that is, they say almost, really, because the real estate agents need to handle the last mile. So as I mentioned, a lot of people can do the searching, figure out locations. You can work on your phone or via an application on your computer, get yourself pre-approved. There's times where you can actually go to the home and see the home, almost like an open house, or tour the home without having anybody there to let you in, etc. So the real issue comes down to putting contracts in place, and the pros and cons of that. So that's where this information is kind of saying that we're still going to need guidance to a certain point when it comes to the last mile, which really is contracts. There's a lot of contract language. I know, I'm in Florida. If you're in California or anywhere else in the country, you typically have a state association of realtors, and they have contracts that typically have an as-is contract and your typical standard retail contract. So most people who are going to buy property are going to use a standard retail contract. It's usually 12 to 15 pages, lots of terms and conditions, lots of things you need to understand. So that's where the use of an agent certainly comes into play here. I'm not advocating either way. I just know that I've seen a lot of contracts out there when people are trying to buy property themselves, and they're very, very weak, all right? And they leave both the buyer and the seller exposed to issues that you're not even contemplating when you're doing real estate transactions that can come and get you afterwards. So you got to keep that in mind. So it's really contract law and putting that together, which is important. And when you take a look at where this is going to go and evolve, and I think we've spoken about this the past couple, videos, and my concern really is, people beating us to the punch and to the property before we're even aware of it. But it's kind of like, so how are we going to combat this? Well, a lot of real estate brokerage firms now that exist, so the big name brokerage firms, are already either creating or in the process of implementing their own iBuying programs. So you can come to their website or come to their sort of infrastructure and say, okay, you don't want to use the full-blown real estate opportunity that we have here as a complete brokerage house. That's fine. Well, we can put you on our iBuying side. So how they're going to combat this, they're going to have their own internal iBuying, which is fine. But in the end, and this is really an important point to make here, is that there's always when new technology comes in, there's, as we say, it's market disruptions and things change, and there's casualties. So who will the casualties be with artificial intelligence and everything that's going forward with everything that's being online and all the algorithms? Well, we're going to see real estate agents will be casualties. We'll see the commission level will be casualties. I mean, there's contemplation that agents will bid There's already like bidding platforms. So, you might have 3 or 4 qualified agents that could list your property, but I'm going to bid against, the guy down the street who wants to list as well too, and you're going to get your best price. So, that's, so again, we're financializing and we're doing real estate. We're making it more of a commodity because now my services or the real estate agent services are being, are being flushed out, and people are now starting to bid, and that 6% is sort of going away from I guess you could say we're away from the norm. But the real issue is going to be that, who are going to be the companies that are going to provide turnkey solutions. And what I mean by that is one-stop shop where it's easy for you to essentially buy, market, finance, and transact the whole process. So wouldn't it be nice where you can, look at your application, you can deal with a company that's going to buy your home at your convenience. You're going to look on their inventory and find something you like, so you'll be able to figure out when you're going to move, when you can jump into this home over here. They've got a finance arm built in. They've got back office transactions, so your title and escrow, closing, the whole bit. And really, you don't have to leave the comfort of your own home. So, this is where the market's going to, and that's going to be, the winners are going to be people who can offer the one-stop shop, the full turnkey. And again, I'm not having to go out. I don't have to get a real estate agent. I don't have to find a mortgage company. I don't have to find a title company. I don't have to get different inspections and appraisals. The people I'm dealing with have it all built in at once. Now, is there advantages to that? There is, and obviously the people who are going to provide that, they're going to earn money, so they can maybe charge less commission because they're earning money piece by piece, etc., on each one of the I guess you could say each one of the components of the real estate transaction. So please realize that that's what can happen in this situation. Is it good, bad? I don't know. Just we have to be aware of it, and we see that these things are changing the landscape of our real estate industry. And like with any industry, it starts off, it matures. Typically, technology is the game changer and really changes our thought process, our use process, makes some things irrelevant and disposable, and others more important. So that's what I'm saying. We're going through this change in the real estate environment now that no one's really contemplated on a massive sort of structure. So there you go. Also, just as an FYI, this is from Housing Wire, from the Mortgage Bankers Association, sliding mortgage rates not enough to boost growth and application volume. So again, that sort of famous quote we hear on every article now saying, everything is, sales are down, and no one's buying, rates are going down, and no one's applying, again, despite the low rates. So whatever is going on at this point in time, whether it's apathy, whether it's fatigue, whether it's just we don't see enough decrease yet, or people are just tired of this whole real estate game. People are just getting, they're mentally broken down now, which, I can see that happening. Lower rates are not increasing volumes. So where we're seeing some increases, so it really is, there was a pickup in government refinances with FHA activity jumping 17%, but pretty much the index overall slid about 0.1%. So that's not a huge slide, but it's flat and it's dropped from the week before. And when you take a look at that, government refinance applications reached another survey high. So the refinance amount is 282,500. So we see that government activity, so the stuff they're backing, which to me is not surprising because they're allowing either different higher debt to income ratios, things like that we've talked about before. So FHA, Fannie and Freddie are making it easier for people to buy, refinance, whatever. So obviously, refinance share of mortgage activity just dropped slightly. Adjustable rate mortgages retreated 5.2% of applications. FHA share of mortgage apps rose last week from 9.6% to 10.1%. The Department of Veterans Affairs share of applications moved from 12.5% to 12.8%, and the Department of Agriculture's share of applications held steady, at 0.6%. So again, we're seeing a trend where the application growth is more on the refinance side, but on the purchase side, well, actually on both, it's going to FHA, which I'm going to have to say it's probably because the standards are a little better than conventional stuff out there. So for all of you people who have said many times that we're not going to have housing bubble issues, and the reasons being because we have what's called QM, qualified mortgages, our standards are higher. Well, this just shows and if you start looking at the components of these type of mortgages, it's easier to qualify, and the standards have been loosened. I'm sorry to say that. So there you go. All right, guess what? We got some rent stuff here. Now this is what's interesting because we see time and time for the past few months that rents are creeping up. So home prices have peaked. Now we're starting to see some year-over-year deceleration, which is great. But at the same time, rents have hit their all-time peak as well too. But when I talk about confusion, what I mean by that is, it really is becoming location dependent, and that's what I'm finding now. So, and again, with all the comments on this channel, because I could be talking about something, and someone's going to tell me, well, where I live, we don't see that. We see it the opposite. We can't find a house, and we do see your prices increasing, and it's still frustrating. So what we're seeing right now is a shift. So it's almost like a shift from location to location. So we see, for example, the West Coast, the Seattles, the Bay Area, whatever, if we see prices declining there, we see people moving out of those locations, cashing out, going to other parts a little more east where they can deploy their capital a little more effectively, and then those locations are becoming tighter, or they're seeing some price increases. So it seems to be doing a little bit of this. It hasn't leveled off yet, and we're probably going to see that for a bit longer. But as far as rents are concerned, the rent rolls, some up or still down. The average still is creeping up. So realize that I've taken everything across the board. We're still moving our way up in rents. But the interesting part that is, if you take a look at the top 16 most expensive U.S. rental markets. This is going from San Francisco, New York, San Jose, Boston, Washington, L.A., Oakland, Seattle, Miami, Santa Ana, California, San Diego, Honolulu, Fort Lauderdale, Denver, Long Beach, and Chicago. Basically, the majority are declining. So the median asking rent prices are going down. Nothing really has gone up. There might have been a couple locations that didn't do anything. They were zero. They flatlined. But your top 16, you're seeing everything go down. And again, there comes a point in time where it's just difficult in these locations where when a one-bedroom average rental market in San Francisco is $3,720 a month, it's a lot of money for rent. Okay, so people are getting priced out of rent as well too, hit their peaks, and now I guess you could say landlords or multifamily units or even single-family rental houses, they're going to have to realize that people just are getting tapped out on this side as well too. So you're tapped out, you can't buy. And now, again, the rental market was riding that wave going, well, these buyers aren't buying, they're going to shift to renting, let's raise my rates. But again, there comes that point in time where there's only so much that any market can bear, whether it's rental or buying as well. So realize that that's going on right now. We talk about cities with the biggest rent increases: Chandler, Arizona; Fresno, California; Glendale, Arizona; Denver; Reno; Spokane, Washington; Scottsdale, Arizona; Gilbert, Arizona. So we're seeing, I think what we're seeing here is that major cities, going more to the burbs or other tier 2 locations are seeing rent increases, obviously. Some cities where the pendulum swung the other way for rent: Philadelphia down, Baltimore, Columbus, Akron, Madison, Wisconsin, Nashville, Seattle, Des Moines, Portland. So again, it's interesting that some locations are rising, some are going down. It just seems to be this hodgepodge. There really seems, for me, I was going to say, is it coastal moving inland? But then again, when you have a Columbus and Akron, Ohio, and Madison they're declining. So in that case, that doesn't quite make sense, because you would think that people are moving inland and rent would be going up. So again, there's probably some figuring out that has to be done here. But just it's interesting that it's localized now. So every market has their own little niche going on, and we'll have to figure that out as time flies. But at least, again, from a summary perspective, rent still creeps up ever so slightly every month, but now we're seeing some major shifts with respect to price declines and rental rate decreases across the board. And last but not least here, just an interesting note, I saw this today, talked about Chinese buyers. And again, I kind of tie this in because it does make sense due to some of the West Coast decreases in price point. Chinese buyers are pulling out of the U.S., And I guess you could say there's a number of reasons for that. Quick little video that was on CNBC today. Due to and again, this is the reasons. I'm not going to validate the reasons, but just what they're stating. It's due to anti-Chinese political issues. So obviously when we got stuff going on with China, there's a lot of stuff going on in the G20 and other issues with China these days. So obviously that's going to affect, maybe there's not a comfort level of coming over here as much as there was. There's been a clampdown on visa processing. So I'm sure as a underlying retaliation, there's going to be some issues going on the visa issuing, stuff like that. So that's going to affect as well too. And of course they say tariffs, so price of goods, that's going to affect back and forth trade and people willing to come over here. Also students going back to China, and I think what that means is they're over here, they're getting their education, but they're going back. And whether that's because of visa issues or whatever, I'm not too sure on that. It wasn't well laid out here. But the point is that what was going on is they'd come here for school, then they'd stay for work. Parents would bring money across, buy a house, they'd live in the house. Now we've got a domicile, now we can bring people over the whole bit. So a lot more students are going back to China. It's also, and this has to be noted, that it's harder to get money out of China to buy U.S. property. So that's really what's been going on. And if you take a look at how they're figuring this out, there's a website called Juwai, I want to say it correctly, JUWAI.com, Juwai.com, and it's about inquiring. So this is a place where you can put, properties here, over there, so everybody there can see your properties. Basically, the inquiries for U.S.-based properties are down 27% since 2018. So over 27% of the looking and inquiries from that website is down. They see property inquiries increased in Canada, the UK, and Australia. So you can see that it's very clear. So where there's lack of issues and more free flow of capital and money opportunities, that's where people are going to look. Path of least resistance. So that's kind of seen. So we're seeing a lot of that right now. And again, but a lot of it too, from what I understand and what I've heard over the past year, is that the Chinese government is really clamping down on money coming out of China. Even though it says here inquiries have increased in Canada, I can tell you on the Vancouver side, there's been a big slowdown in offshore money coming to Vancouver real estate as well. So it's just, this is kind of generalizing, but you can see that it's interesting how this changes the dynamics. So does that affect purchases on this side of the world? Sure it does. Could that affect some of the or contribute to some of the year-over-year sales decreases over on the West Coast? It probably could, because there's less cash buyers, and less cash buyers are bidding up those properties. And what I wanted to point out, and if it's not obvious here in what we've discussed, is that a lot you either buy a home to live in, buy a home to fix and flip or rent out, whatever, to make money. Whereas from the case of the foreign buyers, it typically is to get money out of a country. It's called flight capital. It leaves the country, ends up here. They can establish a domicile here. They can establish some like, again, a footprint. You've got a piece of ground, you put your flag in it, you own that, which is great, and it can assist in immigration process, naturalization, and citizenship, and green cards, whatever. So realize that the less money's coming over, less of that's going to be happening from those cultures. So just something to think about. So anyway, again, it's very interesting. But again, hope everybody had a great 4th of July holiday. I know people probably are still holidaying right now, making a long weekend. So I just want to make sure we tied up the week here with some information. Again, for me, the number one issue really is resale price deceleration, and the fact that the Feds come out in the open and saying, hey, housing slowdown is an indicator of a future recession. It's not like we're not talking about this. They've come out right now and said it as, from before. They did not talk, 10 years ago, they weren't talking like that. So now it's almost like a warning sign saying, we're talking about this, we're looking at it, let's everybody be forewarned here. So that's a scoop. Again, thank you very much for the views, the likes in the video. I appreciate the comments, so please give them those. And as I mentioned before, if you like information on real estate, and if I can assist you in any way, got questions or comments, reach out to me, hit my email, which is typically in the About Us section of the video. It's also, I always put my email in the top comment, which I pinned to the top of the video. So that's the best way, is to reach me via email, and then we can correspond from there. I know that some of you were sort of back and forth, so again, just tag up over the weekend. And again, anything you want to know about real estate investing, stuff like that, I can certainly help you, especially if you want to buy in the lovely state of Florida, where there's lots of deals these days. So again, thanks very much, and we'll look forward to speaking with you next week.